Hey there, future investors. Today, we're diving into the exciting world of stocks as financial instruments. Did you know that when you buy a stock, you're not just buying a piece of paper? You're actually owning a part of the company. This ownership gives you rights, like voting on key decisions, if you hold common stock. But wait, there's more. Stocks come in two main flavors: common and preferred. Common stocks offer potential for growth and dividends, but they're more volatile. Preferred stocks, on the other hand, provide fixed dividends and priority during liquidation, but usually don't give you a say in company decisions. Chapter 4: Stocks as Financial Instruments. Explanation of stocks as ownership and voting rights. Stocks represent ownership in a corporation, granting shareholders certain rights. 1. Ownership rights. Shareholders have a proportional claim on the company's assets and earnings, based on the number of shares they own. 2. Voting rights. Common stockholders typically have the right to vote on key company decisions, such as electing board members and approving major corporate actions. These rights make stocks not only financial instruments but also governance tools, allowing shareholders to influence corporate strategy. Types of stocks: common versus preferred. Stocks are categorized into two main types, each with distinct characteristics. 1. Common stock. Offers potential for capital appreciation and dividends. More volatile than preferred stocks. Typically grants voting rights, allowing shareholders to participate in corporate governance. 2. Preferred stock. It provides fixed dividends, offering more predictable income. Priority over common stock during liquidation or dividend payments. Generally, does not include voting rights, making it less attractive for those interested in influencing corporate decisions. Dividends and their impact on stock valuation. Dividends are payments made to shareholders from a company's earnings. They play a crucial role in stock valuation, especially for income-focused investors. 1. Dividend policy. A consistent dividend policy signals financial stability and confidence in future earnings. Companies that regularly pay dividends are often viewed as more stable investments. The impact on valuation. Dividends contribute to total shareholder return, which includes both capital appreciation and dividend income. Investors often use dividend-based models to assess the value of a stock. Real-world example: Coca-Cola. Coca-Cola, (KO), is renowned for its consistent dividend payments. The company has increased its dividend for 58 consecutive years, demonstrating its commitment to returning value to shareholders. Coca-Cola maintains a dividend payout ratio of approximately 75%, which reflects its strong cash flow from operations and global market presence. This makes Coca-Cola an attractive investment for those seeking reliable income streams. 4.4 The dividend payment process. The dividend payment process involves several important dates. 1. Declaration date. The company announces the amount and payment date of the dividend. 2. Ex-dividend date. The cutoff date for being eligible to receive the dividend. If you buy the stock on or after this date, you will not receive the upcoming dividend. 3. Record date. The date by which shareholders must be registered on the company's books to receive the dividend. 4. Payment date. The date when the dividend is actually distributed to shareholders. Understanding these dates is essential for timing investments around dividend payments. Real-world example: Johnson & Johnson, J&J. Johnson & Johnson, J&J, has been paying dividends for over 50 years, and has increased its payout every year for the past 59 years. It has a payout ratio of around 50%, which allows it to maintain a balance between rewarding shareholders and reinvesting in growth opportunities. This long track record of increasing dividends makes J&J a stable choice for investors looking for both income and growth potential. Stock valuation models. Stock valuation models help investors determine whether a stock is fairly priced, based on its expected future cash flows or dividends. Two primary models are discussed here. Dividend discount model, DDM. The dividend discount model, DDM, values a stock based on the present value of its expected future dividends. This model is particularly useful for valuing companies that consistently pay dividends. The formula for DDM is P0 equals D1 or minus GP0 equals or minus GD1, where P0 equals current price of the stock, D1 equals expected dividend next year or equals required rate of return, G equals growth rate of dividends. Numerical example: suppose a company is expected to pay a dividend of $2 next year, with an annual growth rate of 5%, and investors require a 10% return. Using DDM, P0 equals 20.10 minus 0.05 equals 20.05 equals 40, P0 equals 0.10 minus 0.052 equals 0.052 equals 40. Thus, the fair value of the stock would be $40. Real-world example: Apple Incorporated. Apple, AAPL, initiated its dividend policy in 2012 after years of reinvesting profits into growth initiatives. Since then, Apple has steadily increased its dividend each year, due to strong cash flows from its product lines and services business. In recent years, Apple has maintained a low payout ratio, which leaves room for future increases, while continuing to invest in innovation and acquisitions. 4.5.2 Gordon Growth Model, a special case of DDM. The Gordon Growth Model assumes that dividends will grow at a constant rate indefinitely. It's commonly used for mature companies with stable dividend growth rates. The formula is similar to DDM: P0 equals D1 or minus GP0 equals or minus GD1. This model assumes constant growth over time, making it more applicable for companies with predictable earnings and dividend policies. Numerical example: consider a company that pays an annual dividend of $3 per share, with an expected growth rate of 4%, and a required return of 8%. Using the Gordon Growth Model, P0 equals 30.08 minus 0.04 equals 30.04 equals 75, P0 equals 0.08 minus 0.043 equals 0.043 equals 75. This suggests that the fair price for this stock is $75. Real-world example: Procter & Gamble. Procter & Gamble, PG, has been paying dividends for over a century, and has raised its payout every year for the last 64 years. The company's strong portfolio of consumer products generates steady cash flows, enabling it to maintain a high payout ratio while still investing heavily in research and development, making it an ideal candidate for valuation using models like DDM or Gordon's model. Capital Asset Pricing Model, CAPM. While not focused on dividends, CAPM helps investors understand how risk affects expected returns by considering both systematic risk, market risk, and unsystematic risk, company-specific risk.
CAP formula E RE equals RF plus beta I E RM minus RF, E, RE, equals RF plus beta I, ERM minus RF. Where E RE equals expected return of investment, RF equals risk-free rate, beta I equals beta, measure of volatility relative to the market, ERM equals expected market return.
CAP provides insight into how much return an investor should expect given a stock's risk level compared to the overall market. Numerical example. If the risk-free rate is 3%, the market return is expected to be 9%, and a stock has a beta of 1.2, then using CAP, E RE equals 3 plus 1.29 minus 3, equals 3 plus 7.2 equals 10.2, E RE equals 3 plus 1.29 minus 3, equals 3 plus 7.2 equals 10.2. This means that investors should expect a return of 10.2%, given this stock's risk profile. Risk in stock investing. Risk is an inherent part of investing in stocks, and understanding how to assess and manage it is crucial for long-term success in the market. Types of risk. There are two primary types of risk associated with stocks: systematic risk, market risk. This type of risk affects all stocks across the market due to macroeconomic factors, such as interest rates, inflation, or geopolitical events. It cannot be eliminated through diversification, but can be managed through asset allocation strategies. Example: a global recession would likely cause most stocks to decline in value, regardless of their individual performance. Unsystematic risk, company-specific risk. This type of risk is unique to individual companies or industries, and can be mitigated through diversification. Factors include poor management decisions, product recalls, or industry downturns. Example: a pharmaceutical company facing lawsuits over drug safety could see its stock price plummet, even if broader markets are performing well. Real-world example: Kinder Morgan. In December 2015, Kinder Morgan, KMI, one of North America's largest energy infrastructure companies, shocked investors by cutting its quarterly dividend by 75%, due to financial pressures from declining oil prices. Despite this drastic move leading to an initial drop in share prices, KMI was able to stabilize its balance sheet and eventually restored investor confidence by raising dividends again in early 2019. 4.7 Risk Management Strategies. Effective risk management strategies can help investors mitigate potential losses while maximizing returns over time. 4.7.1 Diversification. Diversification involves spreading investments across different asset classes or sectors so that poor performance in one area does not significantly impact your overall portfolio performance. Example: an investor holding technology stocks may diversify by adding consumer goods or healthcare stocks into their portfolio so that if one sector underperforms due to economic conditions or regulatory changes, other sectors may perform better under those same conditions. Asset allocation. Asset allocation refers to dividing your investment portfolio among different asset categories, such as stocks, bonds, real estate, based on your goals and risk tolerance level. Example: younger investors may allocate more towards stocks because they have time on their side if markets decline temporarily. However, retirees may allocate more toward bonds because they need stable income streams without much volatility from their investments at this stage in life.